You'll recall those happy, halcyon days where we didn't have to rule-driven, we were principle-driven, and everything actually made sense. But now you've got to actually have semi-principles and semi-strict rules. So what is your guide, basic guide? Is to look, if you bought a business, and I mean business as defined in IFRS 3, it's a very particular definition, then you account for it under IFRS 3, even if you paid shares, paid by way of shares. If, however, you bought other assets that don't meet that definition, then you account under IFRS 2. So what is the difference in all of this? Is it a big so what, or is there some consequence that flows? The consequence that really flows, you won't see in an ordinary acquisition of a business or a subsidiary. So those are obviously businesses as defined. They fall into that definition of managing in order to generate a return. So they clearly fall in IFRS 3. The one I just wanted to mention was in relation to property acquisitions or property companies. Now you buy a property company, or you buy the property itself, but particularly buy the property company. Is that an IFRS 2 or IFRS 3? Is a property a business as defined? Well, there's no clear answer I can give you. If it's rental generating, it's possibly arguable either way. If it's not rental generating, it's clearly not a business as defined, and then you must go IFRS 2. If it is rental generating, then you could conceivably go IFRS 3. And what's the consequence of all of that? It's all very interesting in the abstract, but what does it mean? Look at a live example. I buy a property company for R1 million. I issue shares for R1 million. But the shares have a fair value of R1.2 million. It's not a particularly uncommon transaction. They rather pay by way of shares, and the seller says, well, only if you give me them at a bargain price, or a little bit of a bargain price, otherwise I want cash. So in that context, if you apply IFRS 2, you measure your share capital at the value of the asset acquired. Million rand, debit asset, credit share capital, or equity, that's all. Nice, simple, and there's nothing to think about really. But if you go IFRS 3, then you've got to measure the asset at fair value and the shares you issue at fair value. So now I've got debit asset $1 million, credit liabilities credit equity 1.2 million. Now, where does this other 200,000 lurk? Now I've got to deal with that somewhere. I can't add it to the value of the property. The value of the property is only 1 million. So what came before the FRIP is they put this to goodwill. I said, well, how could this possibly be goodwill in a property company? How do you get goodwill? What feature of it is a generator of goodwill? So clearly wrong at a conceptual level. And really that has to be taken through the income statement. Your net equity position is obviously the same, but it has a very different income statement effect. So just worthwhile being aware of the potential danger there if you're sitting at the top level and reviewing this kind of transaction. And again, once there's an acquisition and paying by way of shares, there's always that question of diluted EPS. In all those acquisitions where there's an earn-out, we always have this EPS, and we every now and then get a case at the FRIP where they don't properly reflect the diluted EPS. And that's entirely rule-driven. It doesn't matter whether it's logical or not. It's a rule-driven, and it's required disclosure. And at least at the audit committee level, you can simply sit back and say, where is the diluted EPS? Have you taken it into account? Not for you to do the calculation, but simply to prod the relevant people and to make sure the management and the external auditor to apply their minds to that issue. If we look at, we've discussed property acquisitions in particular, and then just also under the topic of acquisitions and disposals, this question of the set-off of goodwill and the bargain purchase. For those of you plus 45, you'll recall how we used to do it in those simple happy days of a bargain purchase where you created an NDR. Well, that's gone. Now you've got to account for a bargain purchase. It used to be called negative goodwill 5 or 8 years ago, now bargain purchase. And we've seen at the FRIP where the company has a lot of activity in the acquisitions area where they net those off. And that netting off is specifically precluded by IAS 1. So it doesn't apply only here. It's another area, just as a warning at the audit committee level to say, look, if there's any kind of set-off, you simply don't, it doesn't have the facility for set-off in IFRS, except to the limited circumstances in IAS 39, very rule-driven. If it doesn't fit in those rules, everything's shown gross. And a feature that's becoming more and more common, to use the word, is this question of common control. For those of you that are IFRS aficionados, and I pity you, so I know how difficult it is sometimes, you will note that many of them scope out common control. So IFRS 3, very first paragraph says, no, this is not for common control. So it begs the question, also, what must I do if there is common control? If my subsidiary sells to my holding company, or the subsidiary buys all the assets from the holding company, what should I do? What's the answer, since it specifically says this is not within IFRS 3? So let's deal with the next slide, because that feeds off the discussion. What if there's no explicit IFRS for a transaction? I've mentioned IFRS 3 as an example, but it applies to other circumstances. You will know from your experience, in some transactions, there simply isn't a clear-cut answer in IFRS, or it's simply not covered by IFRS. Then what? So what we've seen at the FRIP is that some of the preparers and some of the auditors simply think, well, then it's like a free-for-all. We'll just make it up as we go along, whatever we feel like is a nice accounting policy at the time. Well, that's not the position. What IFRS requires is you must go through the IAS 8 hierarchy. IAS 8 says, where you don't have specific IFRS, then look for something similar. What's the IFRS for something similar? And adopt that. And if there isn't something similar or related, only then go to the framework. In other words, the basic principles in the framework, basic definitions and principles. But it's first the similar or related transactions. So then the ancillary question that arises is, if something is specifically scoped out, and I'll go back to my IFRS 3 example, company buys assets from its subsidiary, or company buys assets from its holding company. How do I account for that? Taking a typical reverse takeover, those kinds of scenarios. IFRS 3 says, we don't cover common control transactions. That's obviously a common control transaction. So, only place you can go to guidance, IAS 8. IAS 8 says, look for related or similar. Well, the related or similar is IFRS 3 itself, which deals with reverse acquisitions. It doesn't deal with reverse acquisitions in a common control context, but it does deal with reverse acquisitions. So that's your most similar. So notwithstanding that you scoped out, you can go back into the standard. There's a widely held misconception by at least one of the major 4 firms that believe very strongly that if it's scoped out, that's it, full stop, you can never go back into the standard. Frankly, they're simply wrong, and the FRIP found them to be wrong, and they had to change the accounts. Because you can go back. It's not because they say you can never use the standard for that common control transaction. It's just that the ISB simply doesn't know what to do with common control transactions in toto. But doesn't mean you can't go back into the standard. And then another issue I wanted to highlight also has been before the FRIP. And again, if you're sitting at an audit committee level, you'd say to yourself, well, what is this? Is a transaction designed to achieve an accounting outcome? This is not a common one, but you will see it occasionally. So we've had instances at the FRIP where an agreement for the sale, very significant, involving billions, there's a condition precedent that an accounting outcome must be achieved, a particular accounting outcome. The whole agreement is posited on a suspensive condition that the auditors confirm that the accounting outcome of this transaction will be X, that certain assets will be removed and so on. Now that is a clear warning signal, because shouldn't your transactions be driven by commercial considerations? The accountant's coming afterwards. As it was described to me by a non-accountant, he said the auditors and the accountants, they're like coming after the war to bayonet the wounded. So that was the description they gave. You're not involved in the murky battle. So that transactions should be run on commercial considerations, not driven by the accounting outcome. And if it is, that's a clear danger signal that, for an audit committee perspective, that your hackles should be up to say, well, how can that be conditional? The whole transaction, the go or not go on a 3 billion rand transaction depends on the account, the auditor saying it will achieve this accounting outcome. I think it's a clear problem, and it obviously puts the auditor in an invidious position. That's obviously one warning sign. Some other warning signs when there isn't IFRS, discuss that, but it is a warning sign. You say, well, there isn't IFRS, well, I must be extra alert to pick up on what the IFRS should be. I'm getting the eyes to tell me I should be completing, but I've only got 2 minutes to go. We discussed the transaction designed to meet specific accounting results. And then I think 2 common sense comments that those who qualified after, or sometime not after, but sometime before 1990, so those who are not the youngest in the audience, will recognize substance over form, which has, by the way, been taken out of the framework amazingly, as a self-standing concept, no longer there, and basic common sense. Because at the audit committee level, there's a natural inclination to feel that you are somehow less skilled than the auditor or the CFO in the IFRS arena. Well, you must make yourself as skilled, but apply the test, which still, for a lot of reporting, will still apply. Basically, what's the substance of a form? What's the common sense answer? That's not going to work, by the way, for the very rule-driven standards, how you account for single stock futures and so on. But by and large, it's a nice rule of thumb at the audit committee to consider those 2 features. Ultimately, ladies and gentlemen, if you're looking for the enhancement of IFRS or compliance with IFRS from the audit committee, it's really what are the risks and rewards for the audit committee. So they've got to be empowered to do it and properly remunerated to do it as well. Thank you very much.